conference to discuss a financial speculation tax. The financial speculation tax is an idea whose time has come, a small levy on all stock, bond, and derivative trades, raise easily $100 billion a year to be used for priority purposes. Today we have a broad coalition that's going to be talking about different aspects of the financial speculation tax. I think one of the things that's interesting about this is the breadth of the coalition, parts of which are represented here, the interest in the twin goals of curbing outrageous Wall Street speculation and a bloated Wall Street sector, and also raising money through a progressive vehicle that can be used for important public policy purposes. We've got 6 speakers, so we'll run through them quickly. I will introduce each of them in advance because we sort of navigate a difficult, narrow terrain, so it'll be time for me to jump up as they maneuver. The first speaker today is Damon Silvers. He is the Director of Policy and Special Counsel for the AFL-CIO. He is also the Deputy Chair of the Congressional Oversight Panel that has been one of the keenest and most important critics of the Wall Street bailout and of the issues around financial deregulation. So we will start with Damon.
As Tom said, I'm Damon Silvers. I'm the Policy Director and Special Counsel of President Trump of the AFL-CIO. I serve as Deputy Chair of the Congressional Oversight Panel. I'm speaking here on behalf of the AFL-CIO and not on behalf of the panel. September of last year, President Trump has signed a letter sponsored by the Aspen Institute, together with Pete Peterson and Warren Buffett, a number of American business and financial leaders, on encouraging long-term time horizons in the U.S. capital markets. The first item, the first substantive proposal in that letter, was that Congress ought to look at a financial transactions tax, not for, although I think revenue issues and budget issues were on the minds of many of the signatories to that letter, but the primary purpose that the letter sought to encourage the adoption of such a tax was to encourage the shift of savings from essentially short-term purposes to genuine investment, which is, after all, what the capital markets are supposed to do, move savings to investment. Subsequently, we have become enmeshed in a global debate about how to pay for repairing the damage done to the world's economy by the runaway financial sector and by the profound failure, measured in many different respects, of the financial sector to do the basic job of moving savings into productive investment. That debate is going on in our country, in the halls of Congress, around President Obama's proposal for a bank levy. It's occurring at the International Monetary Fund, at the European Parliament, and the European Commission, truly all around the world. And the momentum in that debate is clearly shifted from the point where the financial transactions tax was something discussed in a sort of academic sidebars to where it is at the very center of the debate. And there's no more powerful evidence than a speech given a week ago at Cambridge University in the United Kingdom by Lord Adair Turner, the director of British Financial, the FSA, where on the subject, and to an audience of Nobel Prize winners, on the subject of what had gone wrong in economic thinking that had produced the financial crisis, the conclusion of that speech was that there was clearly excess speculation in the financial market, there was clearly economic harm coming from that excess speculation, and clearly financial speculation tax, which is called the transactions tax, is an appropriate response. The European Parliament has a similar resolution last month, and I am here on behalf of the AFL-CIO, but also speaking on behalf of the International Trade Union Confederation, representing over 150 million workers worldwide, and on behalf of the Americans for Financial Reform, a coalition of 200 organizations committed to comprehensive reform of our financial markets and accountability for Wall Street, to say that a financial speculation tax of the kind that Rob mentioned a moment ago, a small levy, basis points, hundredths of a percent, on all financial transactions, ES means not just the question of the monies expended for TARP, but the profound hole in our employment markets, in our labor markets. 11 million missing jobs, a hole in the demand in our economy, the need for further government action on jobs, which is the primary public policy goal of the AFL-CIO, given in light of what will otherwise appear to be sustained 10% levels of unemployment. And finally, setting the fiscal landscape of the United States in a place where it's going to be possible to address the profound deficit that we have in public goods, starting with our nation's infrastructure. $2.2 trillion in monies not invested just in order to keep even that we need to address. That does not get at the challenges of climate change, of electrical smart grids, universal high-speed broadband access, challenges that must be faced in the years to come, have to be paid for. So the financial transactions tax, the financial speculation tax, because it can generate these types of revenue, it can generate revenues commensurate with the problem, because it can do so in a fair manner, in relationship both to the distribution of wealth and to who caused the problem, and most of all, because it will move our capital markets in the direction of investment away from speculation, is at the very center of the policy response that is necessary both in the United States and worldwide to the financial crisis and to the long-term challenge of building a sustainable global economy. Thank you.
Thanks, Damon. Our next speaker is John Fullerton, who's the founder and president of the Capital Institute. In the previous incarnation, John worked for 18 years at J.P. Morgan, where he saw the speculative markets at work firsthand. He ran various parts of their capital markets and derivatives business, and he was J.P. Morgan representative to the committee that was involved in cleaning up the long-term capital management fiasco. John.
Thank you. Damon, I could tell you, attest the conference in Cambridge I was privileged to be at myself, and the speech that Ed Turner gave is a must-see for anyone interested in financial statesmanship and regulatory leadership. I'm sure it's available at INET's website, Institute for New Economic Thinking. It's a bit long, but it's incredibly energetic and direct and honest and brave. So I'd encourage everyone to see that. I'm here to express my own support for a financial transaction tax. I will explain my reasoning for this as well as address what I see as the principal legitimate concern about the tax from the perspective of a financial practitioner. I'm not an economist, and I'm certainly not one of the 6 Nobel Prize winners that was there. Let me first state that I don't believe a financial transaction tax is a proper means to seek retaliation against certain bad actors thought to be at the heart of the financial crisis. Such a tax will be far-reaching and affect virtually all participants in the financial system unless explicitly excluded. I see 3 principal reasons to support the tax. Number 1, and by far the most important, is to combat the short-termism that you just heard about. I believe at the heart of the financial crisis and the ills of our economic system is a malady known as short-termism. We have lost the distinction between real investment in the real economy and short-term financial speculation. FTT should, at the margin, shift investment horizons out to longer holding periods by making high trading strategies marginally less profitable. This would be a uniformly positive outcome, in my judgment. The second reason to support FTT is to improve market resiliency. I believe the financial transaction tax should improve financial system resiliency with only minimal costs to efficiency. As system scientists will well understand, there is a trade-off between efficiency and resiliency. What policy officials need to do is to seek the correct balance between efficiency and resiliency. In its search for ever-increasing efficiency, the financial system became too brittle and it broke. Rapid trading strategies are typically low-margin strategies, collecting pennies on large volumes of trades, either via market-making activity or short-term speculation, or both. Since they are low margin, they are typically employed with leverage to enhance returns. Such leverage, which can be funded or synthetically embedded in products such as swaps and futures, reduces system resiliency at the margin because in a crisis, leveraged capital tends to be the first to be forced out, augmenting the volatility precisely when it matters the most. Leveraged positions are pro-cyclical and therefore hurt system resiliency. Financial transaction tax alone will certainly not control market leverage, but all else equal, FTT should reduce overall leverage in the system and therefore improve the resiliency of the system. The third reason to support this tax is we need the money. Given the massive growth of financial transactions as markets have become more short-term and speculative in nature, there's an obvious and attractive source for much-needed revenue generation that does not negatively impact the real economy. Given the digital nature of trading, collection mechanisms, ideally instituted uniformly across all major financial centers and products, should be relatively straightforward. I would now like to address the principal argument against a financial transaction tax that I've read in the press and in the papers, which is namely the liquidity argument. Clear thinking on this issue is lacking in the public debate from what I've seen, and I apologize in advance that this does get a little technical, but I think it's worth bearing with me. First, I will generalize to say that markets tend to operate in one of two states, what I will call normal states and in crisis states. The impact of FTT in each state of the market is quite different, and the importance of liquidity and resiliency is far higher in crisis markets than in normal markets. In normal markets, which is most of the time, it is true that a transaction tax will have the effect of widening the bid-offer spread to take account of the tax. At the margin, this reduces market efficiency, and in the process, we can expect normal state liquidity to be reduced somewhat. Recall I stated earlier that anything that improves market resiliency will tend to reduce market efficiency. So we must accept a marginal loss in market efficiency if we want to improve resiliency. Note that this is different than efficiency in the economy as a whole. As I stated earlier, I strongly believe economic efficiency would be improved if investment decisions were less speculative in nature and more long-term oriented. Furthermore, I would argue that the value of liquidity in normal markets is vastly overblown. Yes, the largest speculative trading firms care a lot about liquidity. And if asked, is more liquidity better? Certainly the answer is yes. But that's not the right question. The right question is, would you be willing to sacrifice some normal market liquidity at the margin in order to significantly improve market resiliency? This is the question our public officials should be asking. And to this question, my answer is also a resounding yes. Finally, turning to markets in a crisis state, this is where resiliency really counts, and a transaction tax will be irrelevant to efficiency. Let me assure you, when Warren Buffett decided to step in and buy Goldman Sachs stock in the face of the crisis, this was in no way impacted by the fact that he didn't need to pay a transaction tax. Liquidity in a crisis takes on a whole new meaning and relative to day-to-day liquidity in normal markets. Liquidity deserts markets in a crisis for many reasons, but one of them must be related to the amount of perceived leverage in the system, leading to weak hands. This is why reducing excess leverage in the system is important to building resilience. By curbing at the margin high transaction and therefore by definition low margin and high leverage trading strategies, FTT helps build system resiliency. So in summary, FTT is not a cure-all for the financial crisis, but at the margin it will shift capital allocation away from short-term speculative activities toward longer-term investment while improving system resilience and raising much-needed revenues in the process. Thanks.
Our next speaker is Ray Oppenheimer, who is the president of Oxfam America, the global poverty and development organization. And under Ray's leadership, Oxfam has been visionary and looking and is at the root of projects, which they spend so much energy and attention on. We're looking at broader policy questions and looking at emerging policy questions in areas of the financial institutions, figuring out how climate impacts are going to be most severe on developing countries, and now turning attention to an important funding mechanism available to address some of those issues, financial transactions tax.
Thanks very much, Rob. It's really a pleasure to join colleagues here today for this important press conference. As Rob said, Oxfam is an international relief and development organization. We work in 100 countries around the world. We're part of the Oxfam International Confederation. We spend $1 billion a year in both relief and development work in sites all over the world. Our core mission is to create lasting solutions to hunger, poverty, and social injustice. The perspective we bring to this discussion is that of development practitioners concerned about poverty and poverty alleviation in the developing world. In 2008, one of the biggest challenges poor people in developing countries had to contend with was a massive global economic crisis that, frankly, they had no role in creating. The best estimates that we have currently are that more than 100 million people were thrown into absolute poverty by this economic slowdown. The World Bank estimates that 50,000 African children, most of them girls, lost their lives last year due to the economic crisis. These figures are in addition to the pre-existing conditions of poverty and also child mortality. Greed and negligence caused the crisis. I don't think there's any dispute about that, and most of that in this country. And that's why we at Oxfam believe that the banks, the speculators, the financial wizards, and the hedge fund gurus should pay the new tax. They benefited from the frenzy and were bailed out by the taxpayers. But no one bailed out the people who continue to struggle on $1 a day. Their lives were made even harder. Those at fault should now bear the burden of helping this country and poor people everywhere to restore their lives and livelihoods. A small financial speculation tax, to our minds, simply makes good, practical common sense. The poorest are suffering for Wall Street sins. They are also on the front lines of the climate change crisis that Rob made reference to. They're the hardest hit with the fewest resources to adapt. Poor communities around the world are facing severe and more frequent and intense floods, droughts, cyclones, and these are leading to natural disasters and major disruptions in agricultural growing seasons. And for them and for these communities, that means increased poverty. We know from our work and research and tracking estimates made by the World Bank and other institutions that $100 billion a year are needed each year to ensure developing countries can start adapting to the climate change challenge. Building on the resiliency of communities to adapt to climate change, from planting drought-resistant crops to building homes and schools on raised foundations, we can reduce the damage and impact that climate change will have on the lives and livelihoods of poor communities. And even more funds are needed to build effective healthcare systems, ensure girls can attend school, and reduce hunger and food insecurity across the developing world. This tax can raise those crucial funds at a time when funding for overseas foreign assistance is under challenge and perhaps in crisis. Yes, it is justice for the wrongs of the past, but it would also help prevent crises in the future. So to conclude, I'd simply like to say that Oxfam strongly supports our colleagues here at the conference, at the press conference, in supporting the financial speculation tax, and we call on Congress and the Obama administration to take action on this important piece of legislation and financial sector reform immediately. Thank you very, very much.
Thank you, Ray. Our next speaker is Dr. Paul Zeitz. Paul is the co-founder and executive director of the Global AIDS Alliance. Paul is among a small group of global AIDS activists who have managed to bring the price of AIDS medicines down by more than 99% in developing countries and enable over 4 million people to receive treatment, people who are now alive would otherwise be dead. So he has some experience at doing things that initially seemed impossible and making them come true. Paul.
Thanks, Rob. Thanks. It's really a great honor to be here with all of us stakeholders in the future of our country and the future of the world. And I think this is an unprecedented coalition of domestic and global stakeholders that are coming together to champion the financial speculation tax. And as Ray said, we know that the economic crisis doesn't stop at our backyard. As he described, the financial crisis is being hardest in those countries that have already been affected by poverty and disease. We know that millions of people are losing their jobs around the world, and on a personal level, we know that babies and children are being affected dramatically. As Rob said, we're part of a global effort to bring health and AIDS response to build a public health infrastructure and to serve people in need. And the United States government made a commitment to work together as part of a global community to universal access to AIDS prevention, treatment, and care services. We know from our partners on the ground that the U.S. government is backtracking on those commitments. People are now turning away new patients that are in urgent need of the life-saving AIDS medicines that Rob talked about, and other programs that the U.S. committed to are being retreated. So we're in strong solidarity with all of you in the belief that the financial speculation tax offers an urgent and immediate opportunity to fill the funding gap and to continue the life-saving global AIDS and global health programs that are up and running but are fragile. We believe this creates the FST, the financial speculation tax, creates an immediate win-win opportunity for the United States to keep its commitments and to keep our role in the world strong and stable. People are watching this administration, and they've seen the Obama administration flatline or reduce spending on critical programs like the Emergency Plan for AIDS Relief or the Global Fund to fight AIDS, TB, and malaria. There are huge gaps in funding that are pressing right now, and that the credibility of our word and our commitment is being questioned and challenged. So as an advocacy community of AIDS and health and global poverty activists, we stand in strong solidarity and strong commitment with you, calling on and the Congress to take immediate action to institute the financial speculation tax. We see this as a way of continuing to provide the life-saving AIDS medicines to combat TB and malaria and other long-neglected programs on child maternal health and the broader range of poverty issues that Ray discussed. We don't see this as a replacement of the ongoing investments that the U.S. government is making, but we see this as a way of filling the gap and allowing the U.S. to really step up to the plate and be a true global partner and a true forward of bringing these life-saving AIDS medicines to people in urgent need. So I'm going to conclude there. There are stakeholders that we're collaborating with in the European theater, but also throughout Africa and Asia that are mobilizing in support of the financial speculation tax. And we're looking forward to the G20 deliberations as another opportunity for leveraging the financial speculation tax to operationalize it now. And I think that is a key target that we all should rally around.